Hello everyone, welcome to iExamB. In continuation to our series for discussing important topics for Bank of India Credit Officer this year, today I am going to discuss some numericals related to time value of money and the annuities concept. Because this will be important for your exam, calculation of loan amounts, EMIs and all, the understanding of time value of concept and how it can be used in the annuities will be very helpful, and such kind of numericals have come in the past last year also. So before we delve into the numericals, first I will also explain you the important concepts related to these numericals in this video. So you might have heard the saying, many people saying it in the financial world, that a rupee today is worth more than the rupee tomorrow. So why does this happen? That means if you have 10 rupees or 100 rupees today, the value of that is more than the same 100 rupees you may have 1 year later. Why is that so? There are two reasons for it. First being that the money has the ability to grow, right? So all the financial system exists because if you put that money, if you put that 100 rupees say in the bank, it has the ability to grow, right? It will grow at the interest rate that is being offered by the bank. If you invest that money in some FD, or say in some bond, or say in a PPF account, provident fund, that money will grow because it has the ability to earn interest on it. So that is one reason that this is more valuable than the money that you may hold 1 year later. So if you choose to keep that 100 rupees in your wallet and not use it, basically then you are not letting it grow, and therefore you are losing value on your money. And how are you losing value on your money? The other important reason is inflation. We know inflation means increase in the prices, right, of the goods and commodities that we consume. So from, if rupees 100, if you are able to buy a certain product today, say for example, if you can buy a cake today from that 100 rupees, after 1 year that same cake may not cost you 100 rupees but say 120 rupees, right? So your money's value, okay, not the amount but the value has reduced, because initially it could buy one cake, 1 year later it may be able to buy say only 0.8% of the cake. So you are not able to buy the same cake with the same amount 1 year later. So because of inflation, the value of your money has decreased, and that's why today my money is more valuable than what it will be tomorrow. So these are the two reasons of understanding how your money grows or has more value today than tomorrow. Now moving on to another important concept of understanding is compounding and discounting. So here I did say that the money grows at the interest rate, right? So how it is growing, right? Now it will depend at what time intervals it is growing. So when you are trying to find that future value, that after 1 year what my 100 rupees will be worth at a certain interest rate, then that method of finding the future value is known as compounding. What you are actually doing is you are taking your 100 rupees and multiplying by say the interest rate. Say if you are earning 6% on your FD today, after 1 year what will its value be, right? So that becomes your future value, and that method of finding the future value is known as compounding. The opposite holds true from when you know a future value and you're trying to find the present value of it. Say for example, if you know you will get 200 rupees after 1 year from a saving, then how much have you actually invested if that money has been growing at 6% interest rate? So this is basically the same thing as this formula, but we are now trying to find the present value. So we move this here. So present value becomes future value divided by 1 plus r to the power of n. So this method of finding the present value from the future value is known as discounting. Right? Now coming to annuities. What is an annuity? An annuity is simply a series of payment of a fixed amount that is coming at a regular interval. Say for example, if you are paying the premium for your life insurance policy, I hope all of you have a life insurance policy and a medical insurance policy. They are very, very important products. So if you are paying your premium, say you are paying an annual premium and this amount may be fixed. Say for example, you are paying say 1000 rupees for a life insurance premium for say another 40 years. Right? So that is an annuity of 1000 that you are making. Similarly, you may have a loan. Okay, you might have taken a home loan say of 5 lakh and you are paying a monthly installment on this of say 5000 rupees per month. So that becomes an annuity payment because you're making a fixed amount of payment at a regular interval. Right? So these are some important annuities examples that one uses in everyday, maybe using it in everyday life. Now, how is it important for a banker? Say you are the credit officer at Bank of India and a person is approaching you for a loan and he says that I have a monthly income of 50,000 and I have 30,000 of monthly expenses to meet and I will be earning for the next 20 years till I have till retirement, so I will be earning this amount till then and I want a loan. So can you give me a loan and what is the loan amount you can give me if presently the interest rates are 6%. Now you have to, as a credit officer, see how much loan you can give to this person. Say for example, if you analyze and you think that yes, it is worth, he is a credit worthy person, his CIBIL score is fine and I can give him a loan and but I need to find out how much loan can I give him. Right? So that is not an arbitrary number. It's not like my gut feeling or the person says give me 1 crore. I will not give him 1 crore because I will have to see if he is able to repay that money or not. So here is this concept of annuity and time value that will help me find out and calculate. So what I will do here is, see, I know this person is earning 50,000 and he has expenses of 30,000. So he basically has 20,000 available for him every month that he can use to repay my loan. So his maximum capacity is 20,000 per month. Okay, and how much will he be earning this money? He will be earning this money for 20 years, which means he will be having 20,000 for 240 months. Right? So we have to be careful in terms of what the information is. The retirement age is given in years, however his income and expenses are monthly. So I have to basically see how much is he earning on a monthly basis till his retirement. So he is going to earn for 240 months. And therefore, I see if every month he is earning 20,000 and what is that present value today of that 20,000. And that when I sum up, when I add this and this, say this 20,000, I have to find the present value will be divided by 1 plus r to the power of 1. This 20,000 will be 1 plus r to the power of 2. And so on I will go. This 20,000 will become 1 plus r to the power of 240. But what is this R? The R is my rate of interest of 6%, but this is also per annum. So I will also have to convert this into monthly because I have been making these payments on a monthly basis. So basically my interest rate will become 0.5%. So here it basically becomes 1 plus 0.5% to the power of 2 and so on till 1 plus 0.5% to the power of 240. Right? So I have to find this, and when I add all these numbers will I get my present value. So I've been using this formula to find my present value. Now doing that is a very tedious task. Of course we can use softwares, Excels to do that. However, then we can sum up this into a single formula. So that single formula is A, which is your annuity payment of 20,000 divided R by R, which is your interest rate, as per the discounting that has been done on a monthly basis, and then my number of periods is 240. So A by R into 1 minus 1 divided by 1 plus R to the power of n is the present value of my annuity. When we calculate this, we will get around 27,91,000. So this is the maximum loan. It's that this you as a credit officer can give to this person, because only till this amount will the person be able to service the loan. Beyond this, he will not be able to service the loan. Of course, the loan amount can be lesser than this, but this is the maximum. So this is how an annuity formula, and the time value is very, very important for bank officers, right? Now, where all can we use? So one example I have already given you for calculating the amount of loan. Other ways where annuity can be used is to find the amount of the EMI. What will be the EMI on the loan given the interest rate? Or I can also, if I know the EMIs and the loan amount, actually what interest rate has the bank applied, as can also be calculated using the same formula. Now, few numericals I will discuss which are important from exam perspective. The type, of course, these type of questions can be asked in your exam, and one such question was asked last year in 2020. So let's look at the first question. The first question says that Mr. Anand makes an equal 4,000 rupees monthly payment on a loan. So he has a loan already, and his EMI is of rupees 4,000 every month, and the interest rate is 12% per annum, which is compounded monthly. Okay, so it is 12% per annum as we said, but because he is paying monthly, there is compounding that is happening on a monthly basis, and his loan is for 12 years. Then what is the amount of the loan that he has taken? Right, so it's similar to what we were discussing right now. Here the number of periods n is 12 into 12, which is 144, and my EMI or my annuity is 4,000, and my interest rate or R is 12% divided by 12 months, which is 1% per month. So these are the amounts now I have. I can use it in the formula to calculate. Okay, divided by 1% into 1 minus 1% to the power of 144. So this is I will calculate to find. Now some of you may ask in the exam, will we have calculators to be able to calculate them? You will get a clarification. Sometimes they allow certain calculators on the screen. You cannot carry on your own. No, you cannot. You are not allowed to carry anything on your own. They may provide on the screen, but if not, many times they help in calculations by providing you the present value interest factor. What is present value interest factor? Basically, it is the amount of this. They may give you present value interest factors for different aspects. Say for example, they give you this for 12 years at 12% interest rate. They give you present value interest factor for 144 at 1% interest rate, and they give you 2-3 values to confuse, and you have to choose which one. So this amount, basically this calculation is given by the present value interest factor. So that can also be there in the question sometimes to help you do the calculation. So when you calculate solve for this, you will get the answer. Okay, next question. Mr. Vinod, he takes a loan of 50,000. Now here we have the loan amount and we know the interest rate. If the loan is for 5 years, which is paid quarterly, what would be the loan repayment amount of each? So we here have to calculate basically the annuity. What will be the annuity payment? And the key things to notice, what is the compounding? So here it is quarterly. That means 4 times in a year. Okay, so here basically my interest rate has to be converted, okay, as per the quarterly, and my payments will be 5 years into 4. So 20 payments I have to make. So I have to calculate. I know my N, I know my R, I know my PV. My PV is 50,000. Okay, and I have to calculate my annuity. So again, using the same formula. Here I don't know this, I know this. So I know 50,000 is equal to A divided by 2.5%. into 1 minus 1 by 1 plus 2.5% to the power of 20. So this will be my calculation and I have to solve for A, and my answer when I solve will be approximately 13,200. So you can practice exam level type of questions for the entire exam of Bank of India and also for PNB credit officer. In the same section under free mock test, here you will find free mock test for both Bank of India and PNB credit officer for your practice, and also PNB risk officer to practice. So you can go on our website and these are available for free for your practice. Coming to the last question for today. If a company has submitted to you the expansion project plan for 20 lakhs. So again, you are a banker and a company has approached you for a project loan, project term loan, project financing, and the project is of 20 lakh where the promoter will bring in 15% funding and the remaining 85% funding the company has approached to you for bank funding. So you have assessed the loan, the project, and agree to fund the project with the loan to be repaid in 8 annual installments. Okay, so you said, okay, I can give you the loan, you have to repay me it back in 8 equal installments, and the interest rate that will be charged will be 9%. The installment, however, because this is an expansion project, the company says that I will be able to pay only once the project is complete. So from the 4th year from today, I will start repaying. And the bank agrees that, okay, you have to pay 8 installments, but from the 4th year, right? So 4th year onwards, you start paying. So what will be the size of my annual repayments? So again, I have to give my annuity. What will be my each equal installment that I have to pay? Okay, and banks, when they are sanctioning letters, they have a repayment schedule for projects that is already mentioned, right? So you have to make that and therefore you have to include it. So what will be my annuity schedule, or the repayment, not really annuity word we used to understand, but it is the repayment schedule that I have to make, right? So here you have to do actually calculations at 3 steps. So let's look at what. So first we have to find the amount of bank funding, right? So it's a 20 lakh loan project, but the funding has to happen for only 85%. So first step is to find the amount of loan. So my loan amount is actually 17 lakh which the bank is sanctioning. Okay, so I've got 17 lakh loan and not a 20 lakh loan. So that's the first step. Okay, my second step is that I have to pay, however, I have to start repaying after 3 years. See, if I start paying from the 4th year, what it means is after 3 years, right? So for 3 years, I'm not making any repayment. However, the interest always accrues. Okay, the interest always accrues for these 3 years. You're not making a payment, but the interest is accruing. Okay, so on 17 lakh, my second step will be, when my repayments start at 4 years, what will be the amount? It will be 17 lakh plus the accrued interest of 3 years. Okay, which eventually means I can find the future value of, at the beginning of 4 years or at the end of 3 years, what will be the future value of my 17 lakh loan. So my second step is to find the future value after 3 years. Okay, so after that is simple. We were seeing in the first slide, the compounding. My future value is equal to my present value into 1 plus r to the power of n. So my future value is basically 17 lakh into 1 plus r, which is 9% to the power of 3, because for 3 years my interest is getting accrued. So when I solve for this, I get an amount of approximately 22 lakh 1,500. So that is my approximate future value. So now this is the amount that I have to repay in 8 installments. Okay, so I don't have to repay 17 lakh, I have to actually repay 22 lakh 1,500 in 8 installments. So now I will find my annuity using that formula where I know my present value is 22 lakh. So my third and final step is now finding the EMI amount. So that will be 22 lakh 1,500 is equal to my annuity divided by 9%, because all these are annual, right? So they are annual payments, so I don't need to change or convert them at any time. Okay, so 1 plus 9% to the power of n, which is 8. So I will solve for this to find my annuity, and when you solve for this, the amount will come at 3,98,000 approximately. So that is the amount you will have to repay or include in the sanction letter, that at the 4th year you will pay 3,98,000, then 5th year you will pay 3,98,000, and so on till 12th year you will make this schedule. Okay, so this is how you approach the question here. It was a little 2 or 3 steps type of a question. You can see the previous year papers also, as I have mentioned, for Bank of India Credit Officer on our website. These are also available for free under the previous year questions section. We have been conducting classes for credit officers from the beginning of the month of May. We've already done 7 and actually 8 classes. We did some more classes related to important topics, and another 7 to 8 classes we will take in the month of May to cover other important aspects related to credit officer, and thereafter we will continue to do the revision till the end of the exam. The classes are being done and the course has been made and curated by our expert faculty, including experts for professional knowledge who are ex-bankers or academicians in the finance and the account space and risk management space, and for English and for general awareness also. So if you want any more details related to the course, you can reach out to the number mentioned on your website. Thanks everybody for listening. Wishing you all the best for your preparation.